Okay, very good morning. Thursday, 14th of June. Hope everyone is well. Give you an overview of what I'm going to cover. Going to have a bit of a recap of what happened with the FOMC last night and accordingly how the market reacted. Then we're going to look at a few major things that are coming up on the agenda today. Firstly being UK retail sales. Some details there for consideration about potentially how the number might come out. And then we're going to have a look and a preview for the ECB, which is kind of the main focal point of today's trading session. So that's what's on the agenda. And starting off then with last night, with what happened with the Fed. I think just looking at the charts is quite telling of what unfolded, because as you can see here in the top left-hand corner, I've got Eurodollar and cable, and if I just get my tool out so I can identify these areas here, I'll just mark them up across the different charts. So the top, Eurodollar, cable and gold. Got T-notes down the bottom here, and then you've got the equity reaction. Now the one actually that stands out that's a little bit different is if you look at the top three, so FX markets and gold and T-notes, everything bounced pretty quickly. So you had an initial reaction, but as the event progressed and the press conference came, you got a reversal of the initial move. So let's deal with this logically and look at why the market did what it did firstly, which was a hawkish reaction, i.e. the move lower in both Eurodollar and cable on dollar strength. So that's where you get the initial pop lower in gold, yields spiked, gold moved lower, T-notes lower, equities under pressure. So this came because, if you remember, the decision here, what was important, I should start with what wasn't important, was the rate hike. You remember the market was pricing, actually just before the event in itself, a 96% probability of an interest rate hike. So the Fed had done a good job communicating with enough kind of coordination amongst their officials to prep the market up, and so be it, they hiked rates, which was as expected. The key part here was initially the dot plots, but there were a few other things also as well to be aware of. And looking at the summary of economic projections, so this is one of the key things first, but this actually is going to change as of next year, as Powell has announced. But this is looking at what the actual table format of the SEP looks like. And so as it stands at this present point, this is when you have March, June, Sep and December, which are seen as the key kind of more influential meetings of the Fed, because this is when they update these forecasts as well as hold a press conference. Now what's key here is that if you look across the Fed's then expectation about the various main parts of the economy, with GDP, that's probably the least revised, but if anything, change in real GDP projection is up for 2018, 2.8 from 2.7, all the rest though remaining unchanged, but unemployment has been revised down across this year and the next two. PCE inflation, which we know is one of the key ones, we've seen very much so this week, inflation has continued that kind of track higher. PCE inflation was revised also up by 0.2 percentage points, 0.1 2019, and then remained unchanged in the longer run. And the PCE core inflation also revised up. Subsequently, the important thing, it meant that the federal funds rate expectations were bumped up from 2.1 to 2.4, also slightly higher for 2019. So this data is telling you that the Fed now, on a median basis, see interest rates at the end of these years slightly higher than they did before. Not only slightly higher, here's the dot plots. So we talked about this a lot yesterday. I thought this Bloomberg graphic just makes life a little easier. This is looking at what we've got, which is the previous projections, which is March, the ones we had last night, which is June. So if I pop this line over what is the median, you can see the trajectory of that line going out from 2018 to the longer term on the right hand side. If I quickly flick that over, so keep in mind the shape of that curve, and then I pop that one on, you can see it's, these things are subtle. They're not. It's not like a massive change, but that's the key as a policy maker. Is you're not in the game of trying to spook the markets. You know, things are to be done in a gradual and slow fashion. What you can see here then is if the main cluster of the median, we've actually bumped up. We've gone here, and what was key, it only took one person to change, of which they did, and the median was altered to now what was the key headline, which actually wasn't the baseline expectation, but was a considerable risk, is they've now moved to 4 interest rate hikes instead of 3, which they had previously said they were going to do since the beginning of the year. So you can see here, the median here has now jumped. As to then, as 2019, where the median was down here, it has jumped up to this level now at 3.125%, or the median being at that level. So that was the initial hawkish reaction. From a market's point of view, this is what saw the dollar yield spike, consequently gold lower and equities under pressure, with this fear initially of they've taken that move, they're continuing to tighten policy at now a faster fashion. However, as you can see on the charts, that move didn't last long, and we reversed completely, and we've added some to the move as the market, I guess in the euro-dollar pair at least, is now, you know, the Fed done and dusted. They're refocusing now on the ECB, which the credible risk lies on the hawkish side, if anything, on any potential confirmation about the details of unwinding kind of QE or tapering it down. We'll discuss that in a second. So euro-dollar already completely reversed a move, and we're up at the kind of a range which we've been trading here. You can see over the last couple of sessions that line already on the chart there. So R1 could be a potential barrier until the event comes, with traders unlikely to commit too much ahead of the event. The other charts, likewise, the one that hasn't recovered though and continues to remain lower is that of the S&P. Now, one thing is, I think you do need to put the S&P move into a little bit of context. Technically, we've broken through the range of the week, which certainly after the break and breach last night into the close on Wall Street has acted as a degree of resistance on the upside on the pullback in the Asia session. Before then, it just gradually tracked lower. But check out the S&P on a daily chart. And remember, we had a pretty phenomenal rise over the course of the last week and a half or so. And we've got up to that, remember that key area of resistance that we've been looking at, around just shy of that 2800 in the S&P. So the market's responding to that, and I think just given the speed of the rise in which we've had, with the technical area of resistance, not a bad point to then just book some of that long position at that point in time. So even though on the 30-minute, it might look fairly punchy, I think in the broad step back and in the broader context, I think that's a relatively to be expected move at these levels. So the bounce though, why did it occur? Well, this is when your monetary policy terminology kind of comes into play, because this is often when you get what is known as a dovish hike. I don't think this was a classic case of that, because he was overall incredibly optimistic. In fact, he said this comment: the decision you see today is another sign that the economy is in great shape. There's only one other guy I know who's used the word great shape over the last 6 months, and that is our friend Donald Trump, talking about Emmanuel Macron's wife. But hey, that's a discussion for another night. But he was very optimistic. The one thing that he did say though, and 2 other points I want to make here with the Fed, is that Powell said officials have been very, very careful not to tighten too quickly, adding that continuing with a gradual approach to policy seems like the right thing to do. This is kind of classic 101 Fed. This is what really Yellen was known for, delivering hikes, but then just beating the drum of slow, gradual, cautious. So there is still an element of that. One other thing to be aware of for the Fed, to finish this off, is he also announced that starting in January, he would take questions now from the media after every meeting, though he cautioned that having twice as many press conferences does not signal anything. The market's assumption pre that specific confirmation was that if you start to have more frequent press conferences, And let's not forget, the ECB does do this with every meeting, the objective being to be more transparent with the market, to give them better, more near-term information of what the board on the central bank is thinking. There was a bit of a belief, though, that this could be a hawkish signal, given the fact then every meeting becomes live and they can be effectively more flexible, and that could mean more rate hikes. But I think this has been talked about before, so I think the market was kind of relatively prepared for that type of signal. So as I said, Fed has been and gone. I would say overall, if Jerome Powell was looking at the financial markets this morning, he's got to be pretty pleased with himself. He's managed to hike rates, what are we now, 7th in the cycle, and he's telegraphed that in fact he's going to do 4 for the year, not 3, and the markets have accepted that new reality. So as far as he's concerned, as far as I'm concerned, I think he's done a job well done for, from a central banking point of view, in that sense. So moving on, next story of note, something to be aware of, and this hasn't had such a immediate implication for the market, but it's something I think that warrants monitoring going forward. This is some Chinese economic data that came out overnight, and across the board, industrial output, fixed asset investment, retail sales, all came in weaker than expected. Now, people aren't kind of concerned at this point, I'd say, about China. There's lots of other things ongoing. There's things like the trade wars, there's geopolitics, there's European politics as well. There's all these different major macro themes, but if you just turn the clocks back a few years, an economic or fear of economic slowdown in China can have global ramifications, far-reaching. And so, obviously, the Fed is absolutely comfortable at this point. But one thing this data did show, just to give you some statistics, fixed asset investment rose at the slowest pace in the first 5 months since the data began in 1999. Infrastructure investment growth decelerated by 9.4% in the first 5 months, the slowest pace since data began in 2014. And growth of fixed asset investment in service sector unexpectedly decelerated to 7.7% in the first 5 months of the year. That's the slowest pace since at least 1998. So if you're looking at the underlying kind of growth, what's driving it in China, there's some suggestions then as China goes through some kind of internal changes, if you like, to try to manage their economy better in a sense, is having some implications then on their economic performance. Again, worth monitoring. It's not something I think you need to take into great consideration because the markets are looking beyond this at this present point in time. All right, let's move on and let's talk about the big event of the day. First, the ECB, then we'll talk about retail sales for the UK. So, headline on Bloomberg is June or July, ECB debates bond plans future, decision day guide. I did send this out to you, a couple of interesting graphics to have a look at. The key thing here is, let's see if they've got any relevant charts for us, is going to be about the ECB's guidance. Here you can see in this table, let's see if I can make it bigger. You've got interest rates. Now, the general consensus on the street, if you like, is that interest rates, this is not going to be really much of a conversation point in terms of the actual movement of it, i.e. raising interest rates, until well into 2019. The one that the market's really focused on today is QE net purchases and the particular wording surrounding the phrase, i.e. the guidance of which sets the parameters of their purchase decision and also the volume and open-endedness of the QE program. So at the moment, well, let me just bring up what the current language looks like. It looks like this. This was the previous monetary policy decision statement. So to break this down, the ECB event is a two-part delivery. You get 12:45 when you get the actual interest rate announcement. Now, no one's expecting interest rates to change. So again, it's irrelevant to today's event and situation. What we're focused on here is at the 12:45 section, which usually is a bit of a non-event because QE's been in place for a while, they've had their guidance in place, we're nowhere near hiking rates, and actually it's the press conference which usually carries the most weight for the subtle hints about their perception on the economy and future policy thereafter. This one is different, and actually 1245, paragraph 2 of the opening statement is going to be absolutely key for any potential spike in activity where they could alter this first sentence of the second paragraph. What I'm looking at here is when they state specifically about their non-standard monetary policy measures, i.e. QE, they said here previous current monthly pace of 30 billion. So this is the first one here, 30 billion. We know this is continued, or it's due at this point to go 30 billion up until intended to run the end of September of 2018, or beyond if necessary, in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with their aim. So remember, this is why inflation is so key, because they've linked that measure specifically then to the timing around the ending of this process. Now, what a lot of the banks are talking about, and I was reading a Deutsche Bank note this morning which kind of goes along the same thinking, there's a bit of a toss-up between whether or not they're going to give this specific hint or change either June or in the July meeting, is what the markets are sitting on as a 50-50 at the moment. What most banks, though, are anticipating is that we're not just going to end in an abrupt fashion. If that was to be the case, that would be incredibly hawkish. So you'd be looking at euro strength, a spike in European yields, probably the DAX and European equities would come under some pressure. Again, it's kind of, we're not quite ready yet for that type of aggressive tightening. What's likely then, and that Deutsche is saying, is that you might get a scaling down of this figure, i.e. 30 billion, and then also an extension to the end of the year. So let's say we go 30 billion till SEP, and then we go down to 10 or 15 billion, seeing out Q4 before then winding things up going into 2019, with the ambition being then the logical sequence, we raise interest rates in the summer of 2019. Point being, 1245, you've got to be absolutely at your ready, positions cleared, waiting for this specific comment. Does it change? If it doesn't change at all, and you get a copy-paste repeat, actually, you might get a dovish response. And the euro, which don't forget has been climbing this morning and has through yesterday's session, might actually see a bit of a pullback. And in that case, you would expect the DAX and European equities to do the opposite. They'd probably rally, because then you're getting the ECB at least holding fire for now, which might disappoint some of the more hawkish-minded market participants who are positioning for a more kind of definitive outcome. This is that really great table, which I'll reshare with you guys, that the chaps at ING have put together. And this really looks at the 4 major key areas of ECB policy: inflation, growth, forward rate guidance, and QE taper guidance. This is the current ECB language, and then this is what ING have put together quite neatly, being the word potential changes that could signify then how they would communicate in a dovish manner, hawkish, or very hawkish, and the subsequent movement thereafter. I'd kind of X out the movement on the right hand side because this is probably a little bit out of date now. The key point here is understanding the subtle nuances of the language changes. This table could be incredibly useful for that. One other thing today as well to be aware of, the ECB are releasing staff projections. Now, much like the Fed we were just discussing, the ECB also have 4 times throughout the year where they release projections. And these are going to be key for the areas specifically of HICP, so inflation, and also GDP. Do we see any type of revisions to these could also be a meaningful kind of pivot of potential price activity as we go through. These come out though during the press conference, the initial part after he delivers his opening statement. And again, that's part 2 when Mario Draghi will start speaking. That'll be at 1:30. So that's kind of a quick overview of the ECB. We'll talk about this a lot more as we go into the event later. But moving on, the calendar, we do have things coming out later this morning, and I just wanted a quick word with you guys on UK retail sales. So UK retail sales today, the month-on-month is expected at 0.5%. Remember, last month, do you remember that? We had a 1.6% reading. That was a real solid print. In fact, the biggest gain in retail sales since October of 2016. We had a rebound for petrol as road closures due to weather conditions affected travel in the prior month. And so retail sales saw quite a big pop on the upside, certainly breaching the 12-month range, and in fact, probably going all the way back, as it said, to 2016 area. Still not quite up at the highs, though. One of the really interesting things I've read about the UK retail sales data today, and something I think you need to consider, is that better weather. Well, let's go back to the calendar and it will make more sense. Retail sales report for today is for the month of May. What was the weather like in May? The weather was the best May we've had on record. What do people do when it's hot and sunny in the UK? Well, they put on their England football shirt, on comes the Barbie. But what does this equate to? More spending. And so actually better weather, and not only better weather, we can thank Meghan and Harry as well for giving a little short-term boost to sentiment and increase in spending. And so spending in food, leisure, i.e. restaurants, and DIY gardening sales are all expected to see potentially a bit of a spike due to those aforementioned reasons. Looking at the hard data that's come out, which can give you a bit of an indication about the health of retail sales, then Barclaycard, they're a source of consumer spending tracking that you can look at, and they've had a marked increase in spending, with credit card company reporting an increase of 5.1% year on year in sales. Also, the BRC, the British Retail Consortium Sales Monitor, was up an equal amount, 4.1% like for the month of May. So the underlying indications have been strong, and also things like the extremely good weather, the royal wedding. Could these be things that could see then an elevated number? Range-wise, we've got a 0 to 0.7% on the month-on-month. One thing I think you do, though, need to translate this into in price activity is, if then there's a risk of an upside surprise, the initial reaction, for sure, might be a blip higher in the pound. However, if it's down to incredibly hot weather and a one-off, well, let's hope for Harry's sake, a one-off wedding, then you can explain it down to these one-item effects, and this doesn't really represent the underlying health of a true retail performance. So after you get the blip and confirmation spike higher, does it then run out of steam rather than continue to just punch higher? So you've just got to be a little careful with how much of a contribution did those particular factors add to the readings themselves. I'm just having a look. Any obvious upside targets? Well, we've got the kind of weekly highs that we had right at the start of the week, then tracking up to the next kind of double point of resistance that we had at the end of last week, and then the ultimate kind of high from last week, which is a fair distance. You got about 70 pips or so, but I guess at least for the time being, some of the political risk has dissipated now that those Commons votes are out the way, and the government and Theresa May has survived, at least for the time being. So that data, UK retail sales, look out for that if you're looking at the pound. It's coming at 9:30. ECB then, 12:45, press conference 1:30. Do, if you're new in the marketplace, be aware of just being realistic about your expectations of what you're going to look for this morning. Quite often what can happen is you can get a little bit tied up and involved maybe in positions unnecessarily this morning, which then can result in you really two things. One, you put yourself in a negative position, and two, as a byproduct of that, it puts you in a negative kind of psychological state already, going into arguably what could be an event in the form of the ECB, which could spark an interesting move or reaction in the marketplace, and therefore some good opportunity to trade. So with that being said, obviously monitor these events, UK retail sales, and things like that. But what I would be stressing is that you really SWOT up, get prepared for the ECB, know the outcomes and the subsequent reactions. Then you're going to be best armed to kind of tackle the event. And also, don't feel you need to trade the event. You know, trading monetary policy events can be incredibly rewarding, I guess, from the payback that you can get, but that's because it's a high-risk event and it requires an underlying thorough understanding of exactly what you're looking out for. You guys have got the material. I've printed out and given it to you. Have a read of that ING crib sheet, and then you're going to be at least in the best position you can be going into the event. All right, that's it. Have a good one. Good luck for today. I'll be on the chat throughout, so any questions, just let me know. Okay, take care.